Welcome to the March to a Million podcast with Greg DuPont, founder of the Wealth Solutions Network. In this podcast, Greg shares his journey to positively impact 1 million lives by creating an army of financially minded attorneys who embrace an expanded role in their clients' lives. Greg and his guests challenge the status quo in the legal profession and the financial services industry, and show attorneys how they can improve their lives, provide greater value to their clients, and experience greater professional satisfaction. Join us in this movement and strengthen your business by learning how to solve your clients' most pressing financial problems.
Hello and welcome to another March to a Million podcast with your host, Greg DuPont. Epiphanies come sometimes when you least expect it. And Greg and I were just talking to prepare for the show. And he already started getting into the show. So I was like, stop. Nope. We're going now. And I'm hitting record. So Greg, okay. So you sent me an email earlier and said, hey, we're going to have a very candid conversation on the show today. And then you kind of just talked to me about what that candid conversation was. And what you were saying was so good. I should have just not told you to start hitting record early, but open up the show, dude. What are we talking about today?
So I guess I'm going to get real on this one, Matt. It occurred to me a few days ago as I was doing my morning meditation. Actually, this one came on a little earlier than normal. Some would say being awake in the middle of the night, but that's for guys like us. It happens all the time, right?
Yes, it is.
And pieces started coming together. As you and I have talked and shared our concerns about what is the future of the market and what that means to my clients. I know I'm going to do well, and I've shared all along that I've got this beautiful view of the future, but there's this major thing that's going to happen between now and then. And as the pieces started coming together, I found I've been referring to it as kind of a lyric in history. As we've talked about the March to a Million, what this podcast is all about, my effort to protect 1 million families from billions of dollars of loss. And when I pegged that initially, I set that at my birthday, September 30, 2030. And I started pondering on that. And I realized that a year before that, on September 29, that will be the 100th anniversary of the date that is marked as the beginning of the Great Depression. And everything just started coming together, Matt, at that point in time. Why I'm here, what I'm doing, and what the March is all about, as we're trying to mobilize an army of attorneys here and other people in the business to extract their heads from the collective sand.
Nice.
I almost went there, right? To protect families. As I shared with you, when I first visualized the March to a Million, it was a point in my life where I was doing well and looked for what's next, what's the next chapter for Greg. And it came to me then that this is the part I didn't want to share, but you're pulling it out of me because you put me on tape when it was in my brain, my blue baby status, and the fact that I'm here for a reason. And I didn't die, even though they passed last rites to me when I was in the nursery. And I think that's for a reason. And that reason is this March to a Million and the unique opportunity that we have as a profession, as people that recognize the risks on the horizon, to protect families. And that's why I didn't want to share about it. You made me share it.
Well, I think it's important. I think people need to understand that this isn't something that hasn't been well thought out. You have spent time both with brainstorming with other super experty people on why you're doing this. This is a passion. This is not just a great financial decision for you and the people who are part of the Wealth Solutions Network. This is something that you were born or saved to do. And I think that is very, very important for the audience to listen to. But I need to push back on something because you said pulling everybody's head out of the proverbial sand. I don't know if you've really explained what the sand is.
Mm. The sand is the blind faith in the stock market that has been built and sold as something that's a safe vehicle, and that the Ken Fishers of the world say if you diversify it this way, you'll be fine. And the answer is no. Not when this major crash happens. And as we've talked about before, the demographic, social, political factors are all there that this will happen. And it's we have to find true diversification, whether that's through the type of things that I advocate for by offloading risk to insurance companies, or I'm starting to really look into Bitcoin hard now as I've listened to some experts on it, and it's changed my paradigm. And we talk about real estate. We've had a couple of people here on the show talking about real estate as an alternative. But what people don't appreciate is that they're being sold a bill of goods, and that is that the market always goes from down to up. And when they can at least afford to lose, they will.
So the Ken Fishers of the world, and I always joke, and in fact, you and I talked about this when you decided to join our family here at Proudmouth, that you can't market to everybody because you're never going to outspend the Ken Fishers, the Dave Ramseys, the Ameriprices, the Edward Jones, the Fidelities, right? When did you realize this? And I want you to think back. If there must have been a singular point in time where you had the light bulb moment where you're like, this is all wrong. When did that happen for you?
Well, there's always a level of evolution in something like this, right?
Sure.
But the primary piece to the puzzle was when I started researching, what's going on in the structure of the market. And when you start looking at the market post the Y2K crash and Sarbanes-Oxley and all those kind of things, and you start seeing what has happened to the pool of investments, meaning companies, publicly traded companies, how there are fewer and fewer and fewer. And at the same time, as a result of that, now we have private equity that is running amok. And I'm not saying that's necessarily a bad thing, because what's happening is, and this is where all the pieces came together, is that the Fed's been pushing out all this money, and it's been going into the market because that's where consumers are putting the money, and some of it's going to private equity. But here's the kicker on that: with fewer companies and more money going in, what's going to happen to the prices of the stock? They're going to go up without any relation to the value of the companies. And so what's going to happen in the future when we have a government that finally has to face up to its excesses? When we're raising taxes across the full spectrum, well, the retirees that have put their money in the market are going to have to pull out more of it if they don't get directly assessed by the government for that. What happens to corporate earnings when we increase the taxes on corporate earnings? The value of the companies are going to come down. So all these factors are there to kick in between now and September 30, 2030.
There was an amazing anthropologist that my wife and I both follow, and they were talking about the patterns that we consistently see, and they're 100-year patterns. And this has actually been studied. This is not woo. This is literally from the time that civilization documented these sorts of anthropological things. And you just said that September 29th of 2029 really is the beginning, or that 100-year cycle is going to begin again. Now they're off. They're not always exactly pinpointed, right? Because that's not how anything works. But the cycle is happening. We're in the cycle. 2030 is not far away, dude. Like, holy crap, that's not far away at all. And you have a long way to go, brother. We have a lot of people that we need to reach. So let's build the case just a little bit more here. So take what you just said, and I want you to pull that apart even more for the audience. I want you to talk about the lies that we've been told about the stock market and what can be done to save billions of dollars that families could lose.
So I'm going to answer by tying it back to what you just said about
Okay.
the periodicity, the 100th century, whatever. And one of the critical pieces to me continuing to dig into this and arrive where I have arrived was Ray Dalio's piece, Principles of a Changing World Order, that does a similar chronicling of the economic changes and the way that historically this has happened before with countries that have had the position of privilege of being the current reserve currency.
Mm-hmm.
And each time it's ended up the same way. And he points out in chapter and verse in there how we are going right down that path. And it's only accelerated since then. And another book that I've been reading that also points to that is The Fourth Turning is Here. It's a sequel almost to a seminal book from the 1990s about the seasonality of our economy and the way that these 100-year seculums, as they call it, just repeat and how it affects the individual members of that, each of the quartiles in that. So, this stuff is proven again and again in history. And so when you turn a blind eye to history in regards to the market, then you turn a blind eye to things like the tulip craze, to the crashes that we've had along the way. And you also turn a blind eye to the fundamental differences that are in the U.S. stock market now than there were just 20 years ago. And when if you have to accept that reality, okay, and part of accepting that reality is the old adage: you can't fight the Fed, and we know that the market is going up like this because of the Fed. And so until the punch bowl completely goes away, you can't ignore the potential opportunity, especially when you're saving for your future. But if you're going to sit out there blind and bare butt naked in the market, it's going to come back and get you. When you can do things like offload the risk to the insurance companies, you can invest in hard assets like real estate. You can investigate and see if things like crypto are right for you, Bitcoin. It's a completely different regime, but most advisors aren't talking about any of this stuff.
They are not. And I don't know if your audience knows this, but this is what we do for a living is we interview advisors. And in that to me, I can't tell you how many times I've heard those same things over and over again, but I'm going to challenge you because this is why you pay me the big bucks, is to go ahead and ask you these deep follow-up questions. So, during the Great Depression, there weren't a lot of other ways to invest, like necessarily there are today. Yes, there were insurance companies. They're not like they are today. They didn't have all of the same products and services. And yes, real estate was a very good hedge, which saved a lot of the wealthy. But if the world comes crashing down, won't the insurance companies crash also?
So the first thing I want to point out is what was the consumer's biggest problem during the Great Depression? They didn't have income. They did not have income. And so if you build a bridge that allows you at least have guaranteed income coming in to support your baseline needs, then at least we got some certainty there. If we got some of our money that is allocated towards, let's call it crypto. That's going to be sitting there, a small amount of it that on the other side of this change may be worth many, many times what it is now. It's getting from here to there. That's the journey that we are trying to help people. So with regard to insurance companies, one of the things that they're frequently criticized for is that you can't get all of your money out without paying a fee. And when you look at a period of time like the Great Depression, which many of the companies that we work with were there during the Great Depression, made it through. And why were they able to make it through? Well, because they're able to invest and hold for the long term. Mm. They are not forced under distress to get rid of their investments. They can wait for it to come back. They can wait for that business, that building that they bought to recover its value. And they don't have to worry about the run on their deposits that banks do. So that's how they have the time horizon that they can go ahead and withstand if they've been properly structured, properly capitalized, et cetera, et cetera, et cetera. Because there's some out there right now that I'm not too concerned that they're going to make it through.
Yeah.
But by and large, that's how they make it through. You know, I was just read a handful of these anecdotes about major commercial properties. This one was in Cleveland, just 100 miles north of me, that was just sold for like 40% of its value from just 5 years ago. A major in downtown Cleveland, major player down there. I read about in Pittsburgh, the same thing, and the vacancy and all that. So, but an insurance company that is invested in something like that, again, doesn't need to sell it. Private equity may have to. Publicly traded company may have to, but they can wait. Gold. I'm not a big fan of gold, but historically a store of energy, store of currency, if you can hold out. So what's the key? To not have to sell distressed assets and exacerbate a loss. And that's the big lie that the market is setting people up for, because they're going to sell distressed stock, distressed prices.
And that's what RMDs are. I mean, you're forced to do required minimum distributions, even if it's not great for you to have to do the required minimum distributions.
Yeah. Yeah. And why are we doing that? So we can pay taxes. So, you know, we lost diversification along the line.
I need you to pull that apart, because I've had many conversations with the lack of diversification in ETFs and mutual funds. So I might know that, but your audience might not. Would you mind deconstructing that for our audience?
Yeah, most people, the notion of diversification they've been sold is the allocation between stock and bond in your portfolio, and rebalancing that whole smoke and mirrors. And again, as we are looking at a shrinking pool of companies on the stock side of things, and looking at something that's been proven the last handful of major corrections, that most consumers' bond exposure in their portfolio is a bond fund. And, you know, that diversification, that bonds and stocks, is based upon modern portfolio theory, which is a byproduct of the 1950s, looking at the data before 1950. Okay. And it was also a function that was later kind of, not, I won't say disavowed, but the creator of it said, wait a second, it was never supposed to be used in consumer portfolios the way it is. It was for huge enterprises, call it insurance companies, that could hold on to their portfolio until those bonds mature. Mm-hmm. Not a consumer that's going to panic in a down market and sell a bond fund when they realize that the two reasons that works on a big scale is that if the insurance company has invested in appropriate companies or governments that are creditworthy, that they hold it long enough, then they'll get their principal back, and they'll get the amount of interest that they were stated along the way. The consumer in a bond fund gets neither of those. And most consumers don't have big enough portfolios to create a ladder of bonds to make this diversification. That is the Piper song of Wall Street.
The other aspect that I'd like for you to talk about is you said it a couple of times that I'm trying to pull this out of you a little bit more, is the lack of companies that are actually actively being traded. Would you mind just continuing to pull that? So the bond stuff, I think that was a very, very good explanation that I don't think a lot of people truly understand. Let's actually talk about mutual funds and ETFs and what is in the normal asset allocated portfolio when it comes to the stocks.
Well, a lot of people have moved on from mutual funds to ETFs because of the cost, and it's good. But they've moved on to passive use of those indexes. And when I mentioned the number of companies, what people don't appreciate is, I've got the actual numbers here, so I don't know the number precisely, but I'm directionally accurate. That we have somewhere in the neighborhood of 60% of the publicly traded companies that we had during the height of the dot-com situation. Okay. And on top of that, now we have more money chasing that because of the 401k generation, throwing their money in there, the Fed propping things up. And so, when you've got your mutual fund, your large cap stock fund, or your growth fund, all that, they all end up owning the same companies and maybe a little different amounts, and so you can look through history at all the companies that were in that position. I'm going to just use Apple right now. And Apple, I'm an Apple fanboy, been one for years and years. But right now, they're in everybody's portfolio in a big position. That's what's been driving for the last 5 years. And guess what? They're under scrutiny, been sued by the U.S. government for antitrust violation.
Yeah.
Where does that end up? How did that work for the Bells when Ma Bell became all the baby Bells? How did that work for Microsoft when they got sued for the way they had the browsers, right? So we got to think past this, and whether it is insurance as another asset class, Bitcoin as another asset class, or having your funds managed with at least some form of protective override on it. And for God's sake, if you're going to need this money for your income, let's give real thought to how much we need to have on the sidelines. Because if we have an 18-month, 24-month, 3-year adjustment, can we have enough sitting on the sidelines to take it out then and not have to take things out at a distressed price? And that's a personal decision that everybody needs to make with their own advisor.
But the advisors aren't having that conversation, right? So the advisors are consistently arguing the liquidity aspects of what you're talking about and the risk involved with some of the things that you're talking about. How do you overcome those objections?
Well, I don't. It's I just make people aware, and those that say you're right, Greg, I'm concerned something like this is going to happen, and I want to make sure that I'm protected, my family's protected. That's why we start 99% of our engagements with the conversation about income. How do we have enough income to meet our reasonable expected expenses? And so then we can look at, okay, what is the amount of necessary risk that we have to take to keep up with inflation, et cetera, so that we can eliminate unnecessary risk or make sure that the risk is borne by the right party, which is the federal government, not our family.
You and I have talked about this offline before, but people are really not liking the level of risk that even sometimes they say that they're willing to go ahead and take. And I know that generations outside of baby boomers, specifically, our appetite for risk, which would be Gen X and below, is pretty much nothing. We've seen way too much. The writing seems to be on the wall with stuff. We do not have our heads buried in the sand. And so, if you're the listeners trying to attract younger generations, also, this risk conversation is unbelievably important.
Well, and for that generation, that's where being able to have a meaningful conversation around alternative investments like Bitcoin. They're already there. That's what they want to do. And, whether it's directly invested in the underlying asset itself, or now we have ETFs that have exposure to the Bitcoin. Like I said, I'm changing my tune on that. I used to look at it as being wildly risky, and it still is. Except where is the greater risk these days? This is something that's likely to come through the other side, at least according to experts I've been listening to recently. It's something that's likely to preserve its value coming through the other side because of many different dynamics that are involved in that.
Well, and we don't have time for that today, but I think that might be a very interesting conversation to have on this March to a Million podcast, is really start diving into. And I know that you have this in your training, so I'm not trying to steal from the training component of it, but these are real conversations that you actually have with the members of the Wealth Solution Network. Is that correct?
Yes.
Okay. So if you've been on the fence, if you've been listening to this and thinking, is this right for my practice? I think today's episode is really going to be a really good filter. Because either you see the world the way that Greg and the Wealth Solution Network members see the world, or you don't. If you don't, then this probably isn't the right place for you. But if you do, it's really time to start taking some action. So, Greg, where should people go to take some action if they want to find out more about how they can actually implement this into their practice and really truly help save billions of dollars from loss in the families in America?
Best way to get started is to go to www.joinwsn.com. Check out what you see there. Schedule some time to chat with me.
Fantastic. All right. As we wrap up, is there anything else that you want to say before we put a pin in today's episode?
I want to go back to my central theme, because it's been kind of dire, right? Technology and all that stuff. We're heading to a great, big, beautiful tomorrow, from straight out from Disney, right? The carousel of progress. Things are going to be good, but there's going to be an adjustment. There has to be an adjustment. And again, the purpose of this messaging, my mission, is to get as many families safely to the other side so they can enjoy that great, big, beautiful tomorrow.
All right, everybody, make sure that you go to the website. We just make sure that we'll have that in the show notes. You can also follow Greg on social media. He is active on LinkedIn specifically, but please make sure that you're going ahead and following people with the Wealth Solutions Network. And you never know, that other estate planning attorney that you're hanging out with might have already heard this and might have already made a decision. So you should definitely talk to your other estate planning attorney friends about what's going on here, and that you happen to agree that this is the direction that is happening in the world. You can believe it or not, it's actually something's going to happen. And we know that you can either be prepared for it, or you, as Greg said, can have your head in the sand. So for Greg DuPont, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
Thank you for listening to the March to a Million podcast. Click the follow button to be notified when new episodes become available, and get in touch with our team by visiting our website at www.wealthsolutionsgroup.biz, or give us a call at 614-432-8065. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Wealth Solutions Network. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice from qualified financial service providers with any questions you may have.